Well, despite much of the bad news during 2012, markets have done surprisingly well. The JSE, no exception, with the market having gained 26.7% over the year. So how well did managers do during 2012? As I said, joining us tonight, David O'Leary from Morningstar, a fund and a company research business. And of course, if you'd like to know more about their methodologies utilized by Morningstar, you can visit our website and look at a past interview we've done with David on just that. So David, thanks for joining us today, and I'll start off with you. Just looking at the JSE All Share, I mean, in the second half of 2012, we saw the market going from strength to strength, reaching new record highs. So that, of course, would mean that returns from the market were strong last year. But what's your assessment as to what stood out in 2012 and what was different about last year relative to other years?
Yeah, so I mean, it was as you mentioned, a banner year for South Africa. I mean, the areas of the market that stood out, financials had just a fantastic year. It also looks, really sort of sticks out like a sore thumb because of the situation in Europe and the U.S. The banking industry and much of the developed world is still struggling. I think. I mean, you see some record profits, but you don't see the same types of returns on those sectors. I mean, here we're looking at sort of 30+40% type returns at a financial. So excellent there. Real estate. Just general equities, growth, value. All did well. Small and mid caps did well. So it was really sort of all parts of the market, other than maybe resources, which didn't hold up quite as well. Didn't do quite as well this year.
Yeah, we definitely saw that when you're looking at the worst performing categories this year. But before we get into that, I mean, Roland, just very generally for you right now, how is 2012 different? I mean, there were so many worst case scenarios put on the table and none of them played out.
Yeah, I think we must, given what David has just said, take it into context as well that South Africa, if you're a South African investor, you had spectacular returns, 30-40%. But we got to compare South Africa to the world, but we got to look at it in dollar terms for that reason. And obviously the rand has depreciated quite substantially in 2012. So the returns for foreign investors in South Africa are actually not as great as if we were local investors buying the shares here. So the MSCI Emerging Market Index and the World Index have gone up 13 or 15% in that range. We have, in dollar terms, done about 20 to 24%. So we've still outperformed the rest of the world, but not as much as the domestic returns have been.
And of course, highlighting currency risk around South Africa.
Yeah, no, absolutely. And I mean, we're seeing much of that kind of playing out in South Africa at the moment, specifically if you take into consideration much of the downgrades as far as the rating agencies are concerned and so on. But South Africa will continue to be, in my opinion, an investment destination of choice. Liquidity in the market, full market participation here in South Africa, and the ability to be able to buy and sell, at ease are some of the things which kind of earmark South Africa as an emerging market that you don't necessarily get elsewhere. It's a pity that resources didn't keep up last year, to the degree that, some of the other sectors have done. But then again, resources have, had its heyday, and they kind of be a little bit in the doldrums at the moment. And quite frankly, if there's buying opportunities you're looking for, maybe resources is kind of the place that you need to be looking at. Let me just quickly show you what's kind of those best and worst categories looked like during the year. Here you can see the one-year numbers. Those are domestic equity financial funds. You can see the return there at 1 year, 34.9. Real estate general, 31.5, and industrials down at 30.9. And let me just go to the worst performing categories. And there you can see resources and basic industries down minus 0.6%. What goes down goes up in markets. Remember that at some point. And then obviously fixed income, money markets, any of those obviously haven't done as well as equities because, quite frankly, we've sat in a market which has kind of reverted back up again.
So David, just before we get into the actual categories and delve into some of the best and worst performing funds, just run us through very quickly your methodologies again, just a reminder there.
Sure. So you'll see on some of the following slides the reference to the Morningstar rating. And this is, in short, a report card on how well a fund has performed in the past. So 5 stars means the fund has done at the very top of its category on a risk-adjusted return basis. And if a fund is 1 star, then it means that it's done very poorly relative to other similar funds on a risk-adjusted basis.
Yeah, and I mean, I think, there's two ways in which the Morningstar rating works. It's a qualitative ranking and what's called a quantitative ranking. So what we're looking at the moment is a quantitative ranking rather than a qualitative ranking. They're busy working on those qualitative rankings, and at some point those will obviously start being utilized in the total construction process. Let me quickly show you what domestic equity general looked like during the year. There you can see the one-year numbers. Maisie Capital, that's Patrice Moyal's business. You can see there, the Maisie Capital Med Equity Fund up at 35.3%. Standard SA Equity slightly below that at Herman van Veltzer and Paul Swanson's fund. And then Dave Voort's fund just below that at 33.1. Look at the 3-year numbers for the Voort Equity Fund at 22.4% per annum. I mean, those are serious returns that you've gained over 3 years. And let me just go to the worst domestic equity category. There you can see the Elements Islamic Equity Fund, that's run by Mohammed Lunat, and you can see the return there, 4.2. And Discovery Equity, that's an Investec fund that they've farmed out to Investec to run, and you can see the return there for 1 year at 8.8. I mean, interesting to see. I mean, it's a year where even the negative stuff is actually positive, which is fantastic.
That's exactly what I was going to say. I mean, you're still getting returns here, and apart from the Element Islamic Equity Fund, they're all beating what inflation was last year. But David, I mean, just looking at the best domestic equity general funds, all returns there over 30%. I mean, how often do you see this in a market? Obviously, coming from Canada, is this a stellar year for South Africa, or are there years where you see these kind of returns on a one-year basis?
Yeah, it's a great question, because I was just thinking about that as we were talking about this. The markets are certainly capable of this. I mean, Canada and the U.S. both had years, several years like this, from sort of 2003 to 2005 and 6. I mean, they were just fantastic after the internet bubble had collapsed and old economy sort of value stocks started to take off. But it's not sustainable, number one, and number two, it looks like South Africa's had quite a long period of stellar returns. So I think investors here might be getting a little bit spoiled. That said, it's in a whole country and an economy that's in an earlier phase of its development than the United States and Canada, and so you are taking on additional risk and you're being compensated for it, and so it's a positive sign and encouraging, but. I think it's important that investors not get spoiled by it and not come to expect it and turn their noses up at sort of 8-9% returns, which we'd be pretty grateful for in a lot of developed markets.
Isn't it amazing that we've had not very good fundamental and economic news in 2012 with labor unrest and the currency depreciating and these kind of things, but we've actually had a stellar year in terms of equity market performance. We've hit all-time highs many times in the last year. And what it's telling us, and this brings us back to, is this a good year for South Africa? South Africa must be seen as a high beta market to the rest of the world, or a highly sensitive or geared market to the rest of the world. So we are actually going up and up because the rest of the world is also recovering, but we tend to go up by more. Similarly, if the foreign markets start falling, we are going to fall by more. So we are just a geared play on economic growth globally and the outlook there. So despite the not so good domestic fundamental and economic news, that is not what's driving our market. It's just foreign emerging markets and developed markets.
The interesting thing is I've just written an article, and the article's called, Is This the Right Time to Invest? And because that's always what a client asks. The client always says, so is this the right time to invest? And I always said, and the article basically concludes, well, maybe that's the wrong question to be asking. Maybe we should be saying, when is not the right time to invest? Because quite frankly, investing for the long term, you're going to be exposed to markets that are going to be increasing over time. Let me show you some more funds quickly. What we're looking at now is allocation funds. Now remember, this is where a fund manager has the choice to hold various types of asset classes. They could hold equities, they could hold bonds, they could hold a whole range of different asset classes. So there you can see Investec, the Investec Africa Fund. There's a 1-year return at 40.6%. That's Malcolm Gray's fund. Absolutely fantastic return there. Lucas Gray Future Titans Fund. That's obviously a business which I act for as a strategist, run by Brendan Hubbard. And there you can see the return there at 34.7%, regardless of the fact that it's been holding quite a bit of cash of late. Visio Met 10-year fund, again, that's Patrice Moyal's outfit at 32.2%. And let me go show you what the worst categories look like. There you can see some of those categories. The NIF Global Cautious Fund, minus 0.8. Momentum Optimal Yield, it's at 1.1%. So again, the ones that are kind of more yield focused, the bottom end of the categories, the ones who are growth focused, right at the top end of the categories.
Yeah.
Dave, can you just clarify for us what the best allocation funds are? We sort of used to prudential, variable, high, low, medium, equity kind of names. What is an allocation fund?
Yeah, so this is essentially a mega grouping of a lot of those prudential, the different subcategories there that you mentioned, the CISA category. So that's right, yeah. So it's not a great comparison. You're definitely going to expect in a year like this, the funds with the most fixed income and cash exposure to be at the bottom of the list, and the ones with the most equity exposure to be at the top. So I think that's part of the story of what's sort of going on between these best and worst lists here. But the other thing to sort of note is even in this worst list of worst allocation funds, even domestic bonds were sort of doing 6-7% this year. So these funds were either ultra conservative and held nothing but cash, or made some mistakes along the way.
Well,
probably a bit of both.
Let's hit pause there. When we come back, we're going to be delving into foreign equity funds, looking at the fixed income space here in South Africa, and then, of course, wrapping up what we're expecting from 2013. We'll see you after this very short break.